Hey Trader, Stephen here with TradersPlan.com. It is Friday morning, March the 27th. It's been a wild week, so I'm really going to get right into it. We're going to look at the overall market, the big picture. We're going to look at the market breadth, and then we're looking at some individual ETFs. What was up the most this week, what was down the most this week. Looking at the Nasdaq composite right here, you can see from peak to trough, we had a 32, we'll just round up and say 33% correction, bear market, excuse me. Now, and so far, we've already surged 18%, a whopping 18% off the bottom, which is just kind of wild. We haven't quite hit this 50% retracement, right? I got the fib right here. I got the 38% retracement level, and we're right in that zone. And then I got the 50%. This morning, the market is down about 3%, approximately 3% pre-market. But if you kind of if you've been watching the market lately, I'm more interested in where it closes versus where it starts. So it's reasonable to assume when you have the market's best 3-day ever, right? Best 3-day streak ever, which is another wild, crazy stat. The Dow Jones has best 3 days ever in a row. You can expect some pullback. Now, I get a lot of questions like, where is it going to go from here? I think it's just very important because right now you're at the 20-day exponential moving average, which is a great place to kind of get rejected and come back down and kind of retest the lows. I think right now it is incredibly important to keep in mind two things. One, make sure when the market is rallying 5.6% in a single day or more, to not really get that FOMO, that fear of missing out, because it is highly unlikely that the market just comes straight back out of here and hits all-time highs, right? So that's one. Just don't get too freaked out. If the Nasdaq barely closed at the 20-day moving average, but if the Nasdaq can get above the 20-day moving average, let's say Monday or even today, I think that's an excellent place for any stocks you bought to kind of raise your stop. Because the way I look at it is like, look, you got the 50-day, you got the 200-day. If the market can't even hold the 20-day, you can just kind of get out of the way and then let the chop happen. Now, do I think it's going to take another leg down, all this? I really don't think there is a ton of more downside under this low. I believe we can test the low. Now, this is personal opinion right here. And the reason why I say that is because the Fed is pumping money in, the Senate is pumping money in. I do think we're going to get to a point where we flatten the curve. And the main reason why I don't think we're going to take just a full another, get down to minus 50% is because the market is forward looking. So if the market can see these other countries and then we, last about 60 to 90 days, like we have an end date, and that end date is not guaranteed. Anything can happen. But I've always noticed, the market always bottoms, before the recession is done, or in the middle of the recession, or the minute they can see light at the end of the tunnel, the market starts to rally, okay? So I think that we could chop around a bit. We could rally a bit more and then kind of come back down, chop around a bit. But if the market or the curve shows any signs of flattening, I think that's rally time. And I think at that point in time, you need to be prepared. Because even if the curve starts to flatten and the market starts to rally, but earnings haven't came out yet, all these companies just got slaughtered on earnings. The market's going to look at that as history. So we'll just kind of have to wait and see. I am not trying to form an opinion based on price action. I'm really just trying to go with the flow, because when I form an opinion, sometimes it can, hurt me. And I think it's just best to say, hey, if the market keeps rallying, if it goes above the 20-day, great. Any stocks that I have, I'm going to use the 20-day moving average as kind of a stop. If the market falls below that, I'll start to take defensive measures. And, also, right now we've been rallying above the 5-day moving average. I've been talking about, we need that since the 5-day, the pink line has been has been resistance. Now it seems to be support. Look, support, support, support. How many days can that support hold it? I don't know, but in my personal opinion, wait and see what happens today. Yes, the market could sell off over the weekend, but if you want to be in on the rally, you need to have simple rules. Like a simple rule: once the market, holds 2 days above the 5-day moving average, I'm going to be in. All right. Until that market breaks, and then I can get back out. Another simple rule: if the market then climbs above the 20-day exponential moving average, that's my new stop, right? And just kind of raise it, right? Simple trend following rules. These are not complicated stuff. Absolutely anybody can do this. Just know when, give yourself an opportunity if the market does decide to rally a little bit higher to be in. And then, make sure you have a trailing stop, whether it's the 5-day or the 20-day. I like moving averages. They're simple. They're easy to see. So just kind of keep that in mind. So we'll just kind of have to wait and see where the day is today. I'm more worried about over the weekend because the market, sometimes likes to, people like to think about everything that's going wrong over the weekend, and then the market sells off. So I'm completely kind of looking at everything like, hey, as long as the market's above the 5-day, I'm going to try to be in. If the market moves back above the 20-day, I'm going to try to be in some, not a lot, because we are in a bear market, and it's not going to go straight like this. Look at the market breadth. We'll look at the market breadth real quick on the short term. So you can see right here that this is the percent of stocks. Now this was after yesterday's surge. 29% of the stocks in the S&P 500 are now above the 20-day moving average. So again, if you're looking for stocks to play, why not play the stronger ones, the 29% of the stronger stocks in the S&P 500? Why focus on the weaker ones? But you can see right here, what's really standing out. Technology is really holding up relatively well, and I think technology is holding up well because they are better stay-at-home stocks, right? They're more likely if their business is not to get shut down because people can work from home. It's not like retail or cruise line or airline or anything like that is very dependent on people showing up. So technology stocks have held up relatively well. Now, in the past couple of days, the S&P 500 has outperformed the Nasdaq. And I think the reason that is because the Nasdaq is so tech heavy. A lot of people the last 2 days were buying, I wouldn't call it the junk stocks, but the underperforming sectors, right? Waiting on a bailout. And the S&P 500 is filled with more of a diverse portfolio. So you got financials, right? Technologies, that's clear. You got financials, discretionary, industrial, healthcare is showing healthcare and technology. And then you got staples, energy, materials, and utilities. So, in my opinion, I'm looking at these, like, if you're looking for some aggressive sectors and you want to pick the strongest industries and the strongest sectors, focus on industries within the healthcare. Focus on industries within the tech stocks. And I know these are aggressive sectors, but again, they're showing the strongest resilience. They're showing the strongest bounce back. So why not focus on that instead of, hoping that something's going to get bailed out? Like, even if it gets bailed out, those earnings are going to be bad for probably a long time. I think that there is going to be a hangover in the cruise line industry, no pun intended. I think that it's not going to be fundamentally good for a long time. I think it could take a while, maybe a year. And what happens if the coronavirus comes back in the fall? So there's just some industries probably just going to stay away from. And I'm completely fine with that. But that's me. At the end of the day, you have to create a trade plan that matches your personality. So I have to do one that matches mine. And you have to create one that matches yours. But percent of stocks above the 200-day moving average, 9%. We're still very, very low. So, the long-term moving average is up here. We're way down here. It's going to take a while for this to significantly improve. Okay. What was I going to do? Okay. Now, let me pull over this list of ETFs. And so what I did was 237 ETFs, excuse me, I said, okay, what's up the most this week? And you can see palladium is up the most. I mean, that is really, really surging, is now back above the 50-day. But that's more of kind of specialty. So you can see that, the aerospace and defense ETF really, really surged this week, was up 31%. You can kind of see some Colombia did really well, but again, they kind of junked by now. Here's what's interesting. Now you have gold that just absolutely got slaughtered. And I think, which is interesting, because you think, people want shiny metals during a pandemic or during a global crisis. I think one reason why this got hit so hard is because when everything started happening, people started to, buy up the dollar, right? The US dollar, the almighty US dollar. So, that's going to put downward pressure on gold, because if I, look at, let's look at UUP, excuse me, just for 1 second. You see this, right? You see this kind of surge in UUP all of a sudden, and that's the biggest surge in this whole chart. So if we go back to gold, so money was flowing in the dollar and it left gold, and it could absolutely come back. So we'll this could be just kind of one giant master shakeout. So if that happens, I'm going to keep an eye on it, but you do have to keep in mind that gold now is above the 20-day, is above the 5-day, and I think if it moves above the 50-day, you have to take it seriously. All right? So home construction, got beat so hard. It was down 50%, more than 50%, so that's kind of junk buying off the bottom. Here's an interesting idea. Mobile payments ETF iPay is up quite a bit, was up 22% this week. So, this could be, one of those, interesting long-term industries that do incredibly well, especially if people kind of change their buying habits. So, we'll just kind of look and see. And you can just kind of look at this whole list. There's a mixed bag. There's a lot of overseas ETFs, everything from Greece. I'm not buying Greece. I'm sorry. I'm just not buying Greece. Ireland, UK, South Africa. So a lot of other countries have been seeing a bounce. Maybe it's because their curves is flattening before ours. So we'll just kind of have to wait and see. Now on the flip side, what is down the most? The dollar is down, was down 3.8%. Nigeria, Pakistan, I don't think a lot of people are buying this, but you have some, Pakistan's about to get the death cross again. Qatar, so oil. I want to look at oil for a second. USO. It went from 13, right, and now oil, I think, is around 23 bucks. I'm not looking at it, but the price of oil, a barrel, it didn't even rally above the 5-day moving average during this whole time. That is showing a lot of weakness. Can it surge? Sure. But to me, oil is looking like it wants to make lower lows just because of its weakness in a rally week. And so I would stay away from this sector completely. I don't know what's going to happen here. You're going to get a lot of consolidation, a lot of bankruptcies. Yes, you can get a lot of junk buying off the bottom, but why risk it? Now, one thing I did want to show you is you have to keep in mind, if you want to look at the big picture, if I go back to the Nasdaq, we are in a reversal week, right? That is a weekly reversal pattern on the Nasdaq. The problem with this bar is it's so wide. Like this bar is 15% long, or excuse me, 18%. I think we already, this is an 18% bar. So does it make sense to maybe, if you're going to play this reversal in the market, let it ease kind of a little bit? I absolutely do, because it is a long way down. If you play this as a weekly reversal, you buy at the open on Monday, it is a long ways down to get stopped out. Now you could always use a 10% stop loss, but I'm not so certain about just playing this one bar as a weekly reversal pattern until I'm more interested to see where we're at next Friday. Right? What's going to happen over the weekend? what, are we going to sell off on Monday like we did the previous 4? What's going to happen on Monday, and what's going to, how the next week is going to play out. Because we got this rally week where potentially can move above the 20-day moving average next week. I guess it's possible today. But, I want to see where we're at the end of next Friday. That's going to kind of give me a gauge. 1 week is just, it's not a trend, but we are rallying a little bit.